Three, two, one. Well, hello everyone, my name is Brownridge. I'm Director General of the Enterprise Investment Scheme Association, or EASTA as we're better known. So this is another in our series of videos that we're doing for tax planning at the end of the tax year. We just started a new year, so we're heading towards two tax events, the 31st of January, obviously, and the 6th of April, which are super important for clients and financial advisors and financial planners. So we want to do a series of videos, just speaking to some of our fund managers, speaking to some of the sponsors of our webinars that we've been doing to talk to them and get some ideas from them, kind of scrape their brains out, if you like, get some thoughts and ideas about what we need to do for tax planning purposes towards the end of the year, and also perhaps to look back over the course of the year and see what's happened. So I have with me today Fred Soneya from Haatch Ventures. Fred, do you want to say hello and just introduce yourself?
Morning, Mark, and morning, everyone that's listening. I'm Fred, co-founder and partner of Haatch and Haatch Ventures. For those of you that don't know us, we've been around for 7 years under the Haatch umbrella, angel investing our own private money into early stage companies, primarily EIS in the UK, but we've also done a few US deals. And then a couple of years ago, we launched Haatch Ventures, which is our EIS fund.
Brilliant, thank you very much. So we're just talking a minute ago saying it's been a year since you've been EASTA member, so congratulations, happy birthday, all those good things. But more importantly, you'll see it's been a year since you kind of hit the advisor market and started to, I guess, transform a little bit from doing the angel investing that you just talked about towards advisor market and spreading your net. So just talk us through, well, first of all, why you made that transition from angel investing to advisor market, and yeah, just give us a kind of overview of 2020. And that surely take only a couple of seconds because not much has happened this year.
2020 has been our busiest year yet, so I can talk about it for hours. We transitioned Haatch from us as individual angel investors into an EIS fund because we had built up this really cool brand that had great early stage investment opportunities. You know, really, I would describe it as unrivaled deal flow because we were known in market of investing early and supporting our portfolio companies really well in this kind of smart money approach to get them to Series A and beyond and ultimately exit. And a couple of years ago, we started turning down opportunities, not because they weren't great, but because there's only so many checks we could write a year. So we launched Haatch Ventures. We spent the first year raising from, we wouldn't necessarily call it friends and family, but a close network of people we knew. High net worths that over the years had expressed interest in investing alongside us and Haatch into EIS companies. And we continued that same investment thesis. So today we own about 22% of the fund as partners. So we continue to angel invest, but via the EIS fund. So we're absolutely aligned with our investors. And then in 2020, we really launched into the market for advisors and any high net worth or sophisticated investor at what some would say is probably the worst time ever during COVID. From our perspective, it's actually been the busiest year ever. And the reason for that is we have to describe this year as this once in a lifetime digital transformation event. Like, you know, this interview right now is being recorded on Zoom. Mark, you probably never would have done that a year ago.
I've never heard of Zoom at this time last year. It's crazy.
So the whole world has changed and continues to change. So we are investing in, you know, the tech that is disrupting all of these changes, and the consumers that are adopting it quicker than ever, and the enterprises that their roadmaps have suddenly accelerated. So 2020 has actually been a substantial year for us. We've made 17 individual investments. That's a mix of follow-on opportunities into existing portfolio companies and a bunch of new companies. And we've broadened our horizons. We started off primarily retail, which is our background, grown into B2B SaaS, and now we've invested in a bunch of different verticals. But the one thing that underpins all of those verticals is digital transformation. So whether that's AeroCloud, which is transforming the aviation industry and allowing airports, which again sounds slightly strange during COVID, but they're still into American airports. America has been busier than ever. Thanksgiving in America, in Florida airports, was the busiest ever in their history. To Buy Me, which is providing on-demand grocery delivery in as little as an hour to you at home, to Poplar, which is doing augmented reality. And we just closed a deal last week into an amazing business, which is helping students find places to live, find housemates to live with, and then handle the entire process end to end, including bills and splitting those bills between people. So there's kind of this common theme of transformation, and 2020 has been very exciting.
Very good. I have a bit of a thing about kind of phrases and words, and you mentioned a couple there, so I just want to delve a little bit deeper if I may. So you mentioned smart money, first of all. Can you just give us your kind of definition of smart money is?
Yeah, I think it's good to be pulled up on these words because I think they can become catchphrases
Yeah, talk about
or
tech.
used
Tech's
to
the
often.
worst one. Tech can mean anything. It just covers a multitude of sins, doesn't it? But that's a whole other seminar. But
Yeah, we can do that. Smart money for us is we take a board seat in every company we invest in. We invest in businesses that we feel we can add value. So we are too excited by the companies we invest in. And I mean that in a positive way. I could only invest in something that I get excited about, that I understand that I want to add value. And therefore, we can't work on a spray and pray approach or a complete arm's length approach because we want to know what's going on. We want to feed in ideas. So smart money for us is anything that's value add over the top of giving somebody a check. And that can be anything from introductions in the market to helping them hire to marketing and go-to-market plans or platform or whatever it may be. So that's what it means for us.
okay, I guess then when you're an entrepreneur, so obviously you're an entrepreneur, you come to you guys, you want the money. So when you say actually, we want to be smart investors, we want to sit on your board, we want to help this, and are most entrepreneurs happy with that, or do they say no, stuff off, it's my business, I want to do it my way? Do you need to then? I guess you need to find the right partner to do that with. Is that the point?
Yeah, I think there's lots of money in the market, so people can raise money, and we have lots of entrepreneurs that come to us that have raised a kind of pre-seed, either friends and family or an angel round, where they've got the money, which ticked a box, but they haven't got anything else. Or we have entrepreneurs that have come to us that are multi-exit founders that have exited a company before, and they don't need to raise the money, but they're raising it because they want to work with people. So one of the things we ask all of our companies when they pitch to us is to tell us why they want to work with us. And you get a sense then, right, at both sides. I guess there's always a caveat and a line. We're not looking to run companies. We are fund managers. We are investing in companies. But we're like puppy dogs. We get excited and we want to play, and we want to help where we can. But absolutely, it's the founder's company. It's their business. But if we can provide some support over and above money, then that ticks all the boxes for us.
Yeah, that's great to hear. Except for me, it's one of the biggest separators from what we do in the IS management world to what an OIC or a unit trust or an ISA manager does, because they are literally using algorithms, using their computer to find great companies to invest into, but probably never speak to them, or very rarely speak to them on any kind of day-to-day, let alone probably month or yearly basis. But yeah, you guys are on boards, you're actively involved, you are literally taking this company in the right direction, and that's why you're involved. That's why your money is smart, as you say, and that's probably why your fees are slightly a little bit above some of the other funds that I mentioned already. But that's what you pay for. It's that direct involvement or active.
Yeah, absolutely. And I think the big benefit to all of that is ultimately when you get to an exit or when you go through an exit phase. So we are becoming very hands-on with M&A. So we have a deal in M&A right now. We've appointed an M&A house in America, which we've discovered through our contacts there. But we know the business very well. So when you're analysing a company as an arm's length fund investor, and you're looking at key metrics, whether that be revenue or growth or whatever it may be, that may not be the real reason for why that company is acquired. And actually in tech, more often than not, it's not revenue. We had a $28 million acquisition on a company that was doing £30,000 a month revenue. They did not buy it for revenue. They bought it because they could see the bigger picture. And by us having at least some understanding of that company, and actually I think we have a lot understanding of all of our companies, we can see more. We can see the bigger picture and also help the founders as well.
Yeah. And the other word that I was going to pick you up on, the phrase I was going to pick you up on, was digital transformation. Again, can you give us a kind of definition for that one?
I think transformation for me is, is this conversation right now. We touched on it briefly. The fact we're using Zoom. I think that's obvious. I guess what's less obvious is the consumer uptake of technology and the enterprise uptake. We invest in a lot of B2B SaaS. So these are software as a service companies, subscription-based companies selling into enterprise customers. They sell into consumers at one end, and then they work their way up and they sell into enterprise customers. Those enterprise customers, traditionally, their roadmaps were 2, 3, 4 years planned in advance. Their procurement process and sales process, it could take 2 years to sell a piece of tech into one of them. You try selling Zoom into an enterprise business in the UK a year ago, it would have taken a year. Sounds bizarre, right? But there would have been security and procurement and legals and a whole RFP process. That's being disrupted. Companies are having to adapt. They're being forced for the first time ever, which is providing all of our portfolio a really unique opportunity to get in and to land and expand. The other kind of area that really helps with is cost saving. So AeroCloud is one of our newest portfolio companies. They provide a complete airport system. So it runs everything from the boring stuff like the flight information display system, they call FIDS, to the really fancy stuff around airport intelligence of there's going to be 4 delays tomorrow. This is where you need to route people, or this plane has come into this gate, you now can't put this plane on this gate, or the baggage queue needs another person because there's X number of people there, the dwell time's too long, so on and so on. They are significantly cheaper because of their cost base than all the old incumbents in the market. So the transformation there is that airports who have been hard hit are looking for cost reduction. And if a company can provide, at the very minimum, a like-for-like platform, and actually AeroCloud do a lot of interesting stuff on top, then there's a significant reason to go for that. So transformation can mean a number of things, but I guess it's the speed of change, which is impressive.
And I guess with COVID, what we've seen is that existing trends and patterns that were going to happen maybe over 4 or 5 years have just been super accelerated and come into being. You use the example of Zoom. I was reading about Hopin this morning, a company again that probably wasn't around this time last year and has now had £2 billion, not even £1 billion, £2 billion valuation. So, virtual online conference facility. So, yeah, it just goes to show that these companies are out there, and if you invest at the right time and you find those right companies, that there are fantastic returns to be had, I guess, in that sense. Which brings me, I guess, to my next question. Having looked back over the year, obviously we're heading towards tax year end. You're obviously getting all your companies in a row to invest into. How's that looking for this year? How's your tranche looking?
It's really exciting. So we are closing our next tranche on the 19th of March. So about 2 weeks before the end of the tax year, and we're fully deployed by the 2nd of April. So that gives all of our investors and advisors the ability to invest again with us this year, or for the first time with us this year, and to have full deployment in this tax year, and obviously also carry back to the previous tax year. Yep. For us, we are working on those deals now because we, again, don't want to spray and pray and don't want to make last minute investments because we have to. So something that we take very seriously is not investing for investors' sake. And the end of tax year tranche is kind of a double-edged sword because in one sense you've got this amazing opportunity and Q1 is very exciting. In the second sense, you could raise £500,000 more than you were expecting in the last week of the tax year. And what do you do with that money? So for us, our philosophy on that is twofold. One, we will have 4 to 6, like usual, new investments lined up. We will have all the legals done ready for the end of the tax year, and we will build some flex into those numbers so that depending on where we end up closing the tranche, depends on how much we can invest. We also like to provide all of our investors with an average of 1 follow-on deal into the Haatch portfolio in each tranche we do. So we tend to do maybe 4 new deals and 1 follow-on deal. So again, we're going to have a couple of follow-on investments lined up for the end of year tranche. And what's important about those follow-on investments is they're not follow-on investments because we need to spend the money. They're follow-on investments because there's companies going out and raising from lead VCs at a slightly later stage, and we have the ability to follow on, and the timing works really well. So yeah, Q1 is going to be amazingly busy, but enabling investors to invest with us again this tax year makes complete sense in terms of our pipeline and deal flow, and also obviously complete sense for investors.
Yeah, and for investors, if they are looking to invest, obviously, come the end of the tax year, how much line of sight do they get in what actual companies you'll be able to put them into, or is it kind of over to you? Do they get to know, but you're A, B, and C, or is it just give you the money and you'll invest at that point?
So it's a really great question. We are fund managers, so it's discretionary, right? So you are buying into our investment thesis and we are making investment decisions. However, of course, in a scenario like this where we're deploying weeks after you've invested. Of course, we know what companies we're going to be investing into, with the usual caveats of any last challenges in legal or DD. So we share with all of our investors and advisors, if they wish, a pipeline of 6 to 8 opportunities, and we tend to invest in 4 to 5 of them. So we probably work on about 10 after we start with a couple of hundred. We end up finding 10 or so that we like. We progress those through. A couple always drop out in DD. Then we have about 8 that we share publicly, and we end up doing kind of 4 or 5 of those. So investors absolutely get an oversight, and that's something we'll be sharing more publicly as Q1 progresses.
Okay, brilliant. Well, I look forward to that. Should be a busy tax year end as usual by the sound of it. So thank you very much for sharing your thoughts today. It's great to hear from you, and great to hear it's going so well at Hatch. I know it's always, not the easiest to start up a new fund and kind of hit the advisor market. So the more funds we have in the market, the more choice we have for advisors, I think so much the better. So certainly recommend any advisors or financial planners out there to speak to Fred and Scott and the team, and go and have a word with Hatch and see how you get on. But Fred, thank you very much.
Thanks, Mark.
Again, no doubt. Have a good new year and good tax year end as well. All right.
Thank you very much.
Fred.
Thanks all.
Right then.
Bye.